So, you've decided that you want to start learning about the stock market. And the stock market's kind of complicated, and there's a lot of videos and a lot of information about out there. Like, especially, like, there's all these YouTube videos. There's also information on different websites that you can look at. There's some people who will even request money, and you can pay them for, like, a course, and they sell their courses. Or there's even other people that are actually professionals that sell information too. But if I want you to take one thing away from this whole video, if you're not going to pay attention from anything else, and the one thing I want you to take away is you don't need to pay anyone any money to get all the knowledge that you need. Like, there are so many YouTube videos out there. Like, even if you're not going to learn it from me, like, and you don't retain all this information that I get out in this video, you do not need to pay anyone any money to learn how to trade stocks. Because, I don't know. I do not think that is needed. But, okay. So, who am I? Well, I'm pretty sure I'm definitely a human. I'm a 20-year-old college student. Currently, my major is cybersecurity, but I plan on changing that to finance because I love finance, like trading stocks and just finance in general. And I've been building computers for 7 years. I'm a computer nerd. And I've been trading stocks for about like 2 years. What is a stock? A stock is a share of a company, and shareholders are sometimes entitled to dividends, but that's not always the case. And dividend is a payment for investing in that corporation. And so basically, some companies will, it's usually quarterly that dividends are given out, distributed. So usually, like, let's say every quarter, a company will announce their dividend of per share, and then they'll distribute it. And then, so you could be technically making passive income while holding it. And that's because the company's making money, so like you're entitled to part of their profits since you are part of that company. Sometimes they act like that, but not every company pays dividends. And securities also usually take 2 business days to settle, but I mean, that kind of really doesn't mean anything though. They're just officially settled after 2 business days because you can technically still day trade, but I'll get into that later. But how do you trade stocks? In order to trade stocks, you have to be over 18, have internet access, and lastly, you must open a brokerage account. If you don't have internet access and you want to trade stocks, I don't know, maybe you can try to walk to Wall Street. Maybe I don't know if that'll work, but you can open a brokerage account. And then as soon as you add money inside your brokerage account, and as soon as that money is settled, you can trade on it. Usually, depends on your broker. But for example, Robinhood, my preferred broker, actually lets you trade the money. Well, up to $1,000 you can trade on instantly, as soon as you start depositing the money. But some brokers wait until the money is secured on their end. But now I'm going to talk about how to place a basic buy order for a stock. You have 2 main options. You can either place a market order, which will buy the stock at any price, or a limit order, which will buy the stock like at or below a stated price. Now, I wanted to mention that early because when I'm describing now, I said what determines the price of a stock, the bid and the ask. So the bid is the highest price that the buyer is willing to pay for 1 share of the stock. The ask price is the lowest price at which the seller is willing to sell a share of stock. So that means both of those people are using limit orders. So, like I mentioned before, like if you're buying a stock, you could also sell a stock with limit orders, which is the last point. So you would choose a limit order to sell your stock to. And most people do that because market orders are kind of unsafe because there is a spread. It says what happens when there's a gap between the bid and the ask. There's a spread. And then the price listed is the midpoint between the bid and the ask. And most stocks are like really liquid, especially Apple. Like you want like this isn't a problem, but like especially like not even just Apple, most just general stocks. But if the stock isn't traded that often, there could be a huge gap between the bid and the ask, and you could see a price and you put your market order in, it's going to get filled at a completely different price because that's the only price it could get filled at because it's the midpoint. And the midpoint isn't always exactly where you're going to get filled. You might have to move limit orders up closer to the ask price until you eventually get filled. Because you're selling your stock to another person. It's not like it's just going into thin air. Like, you're waiting for someone else with a sell limit order. And you're buying it. But, so that's how that works. And then, what would make a stock move so much at one time? So, there are a variety of reasons that could make a stock go up or down a lot in a short period of time. Sometimes stocks even move for like irrationally, or like they seem like they're lacking a reason. But some common events that cause large stock movements are earnings. So quarterly, companies announce their earnings, and they announce their EPS, or earnings per share, and that's the amount of money they made that quarter per share. And they also will have a conference call, and then in that conference call, they'll talk about their guidance, and then like obviously like the results of like the whole like earning call, and like that's a public event you can listen to too. And depending on how that goes, and usually stocks move either a lot up or down depending on their earnings, and then there's an expected earnings per share before the actual earnings per share comes out. So usually if it beats the expected earnings per share, for example, like let's say if they expect to make $1 per share, and they make $1.10 per share, it's going to go up. Whereas if they make 90 cents per share, it's going to go down. And earnings per shares can also be negative. They can be expected to lose, let's say, $1. But if they only lose 90 cents per share, that still means the stock's going up because they did better than they expected, even if they're still losing money. But there's also news. For example, like FDA drug approvals, like for biopharmaceutical companies, like if a drug gets approved, those things skyrocket. But also there's professional companies who have price like forecasts or targets, for example, and like let's say if Morgan Stanley raises a price target or decreases a price target for a specific stock, that'll like obviously a lot of like Morgan Stanley is a very reputable brokerage, so people are going to trust them. So if they say that their price target for them is now down, it's going to cause well, not going to, sometimes in rare cases it doesn't, but it usually does mean like nothing's set in stone with stock trading. A lot of things means usually, but you can also look at technical indicators. There's millions of technical indicators, and volume that can usually also tell you if a stock, because usually high volume means a stock might go up. So what is liquidity of a stock? Liquidity is just the ability to get your money back. Like let's say because you put $1,000 in your brokerage account, you now own all these shares, and you want your, let's say you get into a car crash and you need your money back. And how liquid is your assets? So stocks can be bought or sold during the pre-market from 4 a.m. until 9:30, depending on your broker. And the aftermarket from 4 p.m. until 8 p.m. and that one's depending on your broker. And then you can also obviously trade stocks when the market's open between 9:30 and 4 p.m. And obviously all of this is only Monday through Friday because the market's only open Monday through Friday. And obviously the days the market's closed. Yeah, and like liquidity obviously depends on the volume and the spread of the bid and the ask. So obviously if there's more volume, that means there's like a lot of people that are willing to buy this. So you're not just trying to sell it to like 10 people. If there's 1 million people trying to buy it, you'll probably get rid of it in a second. But cryptocurrency can be traded at any time because it's a currency. So that would be considered 100% liquid. And yeah, you can trade cryptocurrency whenever you want. Or well, it's not even like it's not even a stock though. It's a currency, and currencies never like stop trading. But I digress. There's different types of assets that resemble stocks. There's ETFs. An ETF is an electronically traded fund. it's composed of a variety of stocks. And if you think about it, if you compose yourself of a variety of stocks, you're limiting yourself to, let's say, one company goes out of business. That's just one company in your portfolio. And if one company skyrockets, you're exposing yourself to that specific company. So ETFs are used to track specific indexes or different sectors of the markets, or like a lot of other assets, just like a lot of things. But there's three major market indexes. There's the S&P 500, the Nasdaq, and the Dow Jones Industrial Average. And those three indexes are usually regarded as an indicator of how the market as a whole is doing. So, but the ETF though, for example, like the ETF for the S&P 500 is SPY, and it's a separate ETF because I think a share of the S&P 500 as of right now is like around $3,000, but the ETF is like around 300. So you can like that. I don't know. And there's also a lot of options trades on the S&P 500, but if you don't know what options are, that's okay. But there's also mutual funds. A mutual fund is just an actively managed asset portfolio, which is basically just an ETF, which is still composed of a variety of stocks in one asset, but they're typically managed by like one person or maybe a company or broker, and then they typically have higher commissions compared to an ETF, where a lot of ETFs have very small commissions or no commissions. There's also total market funds. There's the Vanguard Total Market Fund, or VTF, I believe it is, which is just a total market index. Which I mean, like if you look at the chart of the total market, if you're investing over time, like the market, like the Vanguard Total Market Index kind of just keeps going up over the past 50 years. But there's also REITs, which are real estate investment trusts, and you can also buy those, and those usually pay high dividends too. And then that's because they have high cash flow income, because they're getting payments, like let's say from rent, so they pay their investors back dividends a lot. And then, so here's some words you might hear. So your cost basis is the average price paid for a security. And when I say average, it takes the average. So if you buy at different prices, still taking the average of those prices. So you can buy it at a million different points, but it's still going to calculate what your average price is. And then your ROI is return on investment. So, let's say if you sell something for $1,000 and you have a cost basis of $200, that is an $800 ROI, or return on investment. That's some like simple math. And a stop loss is a specified price that you make at the start of a trade. I mean, you don't have to make it at the start of a trade. You can determine it later, but it's smarter to determine it at first. At which you would like to, you change your mind about the strategy. So if you think this stock's going up, for example, you think it's going to go up to a certain price, and you buy it, starts to go down a little bit, you can never call the top or bottom of the stock, so you're not going to sell it immediately. But you let's say if you're down 20%, now you're like, okay, that 20% is my stop loss, and I don't want to lose more than that, and that can save you from just holding it until you lose all your money and being stupid, which I have done a lot of times. There's also a day trade, which is the buy and sale of the same security on the same day. I mean, usually I feel like unless you have a lot of currency, you're not like making day trades, because you need a lot of money to be able to day trade because like there are such small moves over the day. But you can day trade options, but that's option. It's okay if you don't know what options are, but those are a little more complicated. But you can't make more than 3 day trades in a 5 business day period. So if you do plan on doing any day trading, just remember that. This the pattern day trading rule. You can't make more than 3 day trades in a 5 day trade. But if you buy a stock one day and you sell it the next day, it is not a day trade. Even if you buy it at 3:39. Well, no, I mean, like, yeah, why not? 3:39 p.m. you buy it, and then you sell it the next day at 9:30 a.m. It's not a day trade because it was 2 different days. And there's also penny stocks. Penny stock is any stock below $5. And then, so if it's below $5, there's probably a reason. Because the closer a stock is to zero, the closer they're already going bankrupt. So they're either in a bad financial state, a growing new company. They could be a biopharmaceutical company trying to get something approved. Like I said, like they skyrocket when they get something approved by the FDA. If you're really afraid, if you're afraid of losing money, because most traders don't even make money at first. You can, I know TD Ameritrade and some other platforms over a service that allow you to trade with fake money. You just gotta change it to paper money when you're logging in, and then that's how you do it. And you can act like you're trading actual currency, and you can do that until you feel comfortable trading with your actual like real hard-earned money. Because I'm sure like when you're just starting, if you're really scared and you've been doing it, you'll feel more comfortable doing it. But you could, you don't even have to use TD Ameritrade's platform. You could, in your head, just look at a stock and be like, what if I bought it right now? And then just check a little later and like see how you were doing, or like just think about things like that. But is it worth my time to learn to trade stocks? I mean, yes, I believe so. I'm extremely biased though because I love stocks. But it can lead to your financial freedom, and it's been the biggest passion in my life. But only invest what you can afford to lose. Remember that, because especially the way the market is with the coronavirus, and the market's kind of going haywire, a lot of money could be lost. So only invest what you can afford to lose. But I mean, brokers are starting to remove commission fees, so it's getting cheaper. And like a TD Ameritrade doesn't have commission fees. Charles Schwab doesn't have commission fees. Robinhood doesn't have commission fees. Robinhood's my preferred broker. And I know there's so many other brokers that don't have commission fees now too. So if you're not paying commission fees, there's no extra fees you're paying whatsoever. And all of the ones I mentioned have no account minimums, I believe too. But if you do want to start trading using Robinhood, you can use my referral code and you can get a free random stock when you sign up, as long as you make a deposit. But that deposit can be $1, doesn't even matter, and you got a free stock. Thank you for watching, and good luck with your trading.